CNBC TV 18, celebrating 15 years of leadership.
Hello and welcome to Markets Today. I'm Lata Venkatesh and with me is Rupee in the Delhi studio. It was a terrible day on the street. Stocks fell like 9 pins, the currency fell, the bond markets fell, and the only thing that made us look not so bad is the kind of fall we saw in Russia. But really, that was a small consolation. Hi, Rupee.
Hi, Lata. What a day really for the markets. Let's see how it goes. But for now, obviously, lots of worries and concern on the street. Let's quickly run through the top headlines. Terrible Tuesday on the street. Global jitters hit markets with the Nifty losing almost 2% to close below 8,100. The Sensex loses 538 points. Metal and bank stocks crumble the most. IT is the only sector spared on the back of a weakening rupee.
The mid-cap index falls 2.5%. Trader favorite names like Unitech, GVK Power, LIC Housing all cracked between 5 and 11%. However, SpiceJet turned positive after the government allowed the airline to book tickets up to March. Jet Airways also soared 7%.
Russia raises key interest rates to 17% from 10.5%. Its stock market crashes. Collateral impact is seen on Indian companies exporting to Russia. Dr. Reddy's is down 4% and Glenmark tumbles 7% in trade.
The rupee slumps to a 13-month low. Global risk aversion and rising November trade deficit act as sell triggers. Bond prices also come under pressure with the 10-year yield moving back close to the 8% mark. Well, those are the headlines from the markets, and here are the experts that we have lined up on the show for you tonight. Sanjay Dutt of Quantum Securities and Sunil Garg of JP Morgan give us their take on the markets. Bill Gross of Janus Capital Group will tell us how the global picture is looking. And from the corporate arena, we have Habil Khurakiwala of Walkhart on the regulatory issues that the company is facing and many more corporates as well.
We'll get you all that opinion in just a bit, but first straight up to the day's trading action. What a terrible Tuesday it's turned out to be for the market. India's benchmark indices saw sharp cuts as global cues weighed on investor sentiment. Anuj Singhal is here to take us through really how the cookie crumbled today. Anuj?
Well, bad day if you are a bull, because the markets really had a free fall in trade today. Global in nature, but quite clearly the domestic trend of the market is clearly not just sell on rally, but sell on any kind of rally or decline, because intraday you're making a lot of money if you're shorting this market. Clearly, the Russia news was something that the market didn't like. The fact that the Russian market was down so much. Rupee has been coming down. That impacted sentiment, and the back of the market today was broken by the fact that the leading sector banks actually fell by quite a margin. The bank Nifty actually capitulated in today's trade. Take a look at stocks like SBI, ICICI, HDFC. All these stocks were down quite a bit. Metals have been in the bear market, so Sesa, Hindalco, Jindal Steel, Tata Steel, they were all down. The market didn't get support from even the erstwhile defensives like ITC, HUL, Dr. Reddy's, which is having quite a bit of impact due to the Russia issue. ONGC, KN, all the oil and gas stocks were down as well. The only silver lining was IT, but you don't know for how long that can continue. The sense you get is that this really is the real correction that everyone was expecting, but it was not forthcoming. And maybe this time around the market does complete a 10% correction and goes to 7,800 at least, and that's where we'll take it forward from. But for now, it looks like you got to respect the screen, and the screen is telling you that the market may want to correct a bit more.
All right, Anuj, thanks so much for that. What a day for the markets. Whatever little attempt in the afternoon to try and recover from the lows, all that got sold into again. But it wasn't just equities. We've seen a lot of risk aversion also hit the currency space and the bond markets. In fact, Lata, I remember we were discussing just a couple of days ago how banks were reacting to, the hope of treasury profits with the yield coming down. Is all that becoming a thing of the past now?
Well, clearly it was a synchronous fall. The bank index falling along with the rupee and along with the bonds for interconnected reasons. Yes, there were lots of gains, not just in the bond market, but also in the rupee market for a long INR trader for the past 1 year. In spite of the dollar strengthening, it was strengthening against most other currencies, but it wasn't strengthening against the rupee. The rupee and the dollar kept on par, at parity for a better part of the year. And finally, the cookie had to crumble. There were INR, long INR, short euro, long INR, short ruble, long INR, short yen, trades that were abounding for the last 6 months, and that had to turn. The trigger probably came from Russia or from the general sell-off in commodity-based emerging markets because of the fall in crude and other commodity prices. So it was a general emerging market basket selling that brought also India also into the sell frame. And once the sell got triggered, there was profit-taking selling happening everywhere. It would happen in the rupee as well. You would want to take home whatever profits you had. The selling on the rupee was exacerbated by the selling that FII bond funds did. Remember, year to date, while India has got about 1.2 lakh crore of FII equity funds, it has got nearly 1.6 lakh crores from FII debt funds. They were making money on the Indian currency, having entered at 61 and now sitting at 62. They were also making on the bonds, which they had entered at 8.25 or 8.3 yields, and the yields falling to about 7.78 had given them a good 50 basis yield advantage. But that profit taking was what you saw from the funds. Yesterday the FII funds were selling corporate bonds, and today they were selling G-Secs, government securities, and taking dollars home. So we got big FII debt sell numbers, and that had its concomitant impact on the dollar rupee as well, as the dollars were pulled out of the country. The Reserve Bank appears to have supported at about 63.54. We're not terribly sure because it's usually the public sector banks which sell dollars, but it looked like a Reserve Bank support. After that, the rupee somewhat steadied itself. Dealers tell us that this is last of the big sales. At least for now, the rupee appears to have steadied itself, but yet another round of crisis in the global markets can lead to more selling.
All right, so all-round damage today, bonds, the currency, and of course equities. Let's get you some market opinion. Sanjay Dutt of Quantum Securities believes that there is still some more pain in store for equities, and he would avoid buying at least for the moment.
I think the markets are headed for a deeper cut, probably another 2 to 5%. I think it will be a basket selling of EMs. We will probably stand out of the lot and be least impacted, or will suffer the minimum damage probably, because our internal fundamentals are pretty good. I would prefer buying higher than actually, dealing with a falling knife as I'm seeing it right now for the last week or so. Every bounce seems deceiving. So therefore I would like to hold on. And like I'm saying once again, it's not got to do with India, it's got to do with the global landscape, particularly on the currency side and the flows and everything else. Maximum damage I would see right now, if I were to look at the market, would be in the banks, because that's one area which has really risen very fast, and one would see an aggressive correction. If you look at the emerging market currencies, whether the Rupee, the Turkey lira, or whether you look at the Brazilian currency, all of them have got slammed and are approximately 5 or 7 year lows versus the dollar. Of course, forget the ruble, that the rout is playing out. Given this backdrop, I will not be surprised that we'll see a lot of volatility in the rupee here, and probably heading to somewhere in the 65, 66 range very soon. I would keep an eye on the currency more than the indices here and the stocks here.
Well, for an eye on the currency, we have two more experts giving us their views on the Indian rupee.
We need to sort of differentiate between what's happening on a very short-term basis, given pretty serious, I would say, contagion fears at this point in time in emerging market countries. If you look at every emerging market currencies against the US dollar, they've all moved in different directions. INR, and I think the Korean won was the last sort of people holding up, but even the INR has given up today. So everybody's fallen to that.
64, 65 possible. I wouldn't rule that out right now. But I think as soon as oil prices were to stabilize, then I think there'll be a lot more equity and bond inflows back into India to stabilize the currency, and probably also mean a better level to go long the rupee.
All right, lots of views coming in on the currency out there. Let's move on and see what really was taking place in the trading arena, all the action from the futures and options space. Nigel has the day's details. Nigel?
Well, in the derivatives market, shorting the Nifty made you good money in today's trade. But the Bank Nifty futures, for the first time in quite a few trading sessions, there were genuine shorts getting piled into the Bank Nifty. And take a look at a couple of those big banks. The largest private sector bank, ICICI Bank, that one was getting aggressively shorted in today's trading session, while SBI as well did see a good amount of shorts getting built into the system. Take a look at the open interest built up, swell on that one as well. The India VIX, that one popped up in today's session, was up more than 15%. It was trading at 1 month highs, and that clearly showed you that volatility is back into the system. The 8,000 put as well as the 8,050 put, the premiums on both those two strikes were up more than 4 to around 4.5 times, giving you big money if you were a put buyer. On the call side, call writing made you big money. So the 8,300 calls saw the premium fall from around 50 bucks to around sub 20 bucks, while the 8,200 call as well, the premium fell from more than 100 bucks to around 40 bucks. So put buying as well as call writing made you big money in today's trade. Individual stocks that one focus, Dr. Reddy's was getting sold into all through the trading session, ended down by close to around 6%. Adani Power as well as HDI, both of them were getting sold into in today's trade. While on the flip side, HCL Tech as well as Idea, both those two stocks have been seeing selling pressure. Today they came in for a short covering bounce.
Okay, Nigel, don't go away. I believe you have also put together some data on how the market has performed since that all-time high that it hit on the 4th of December. What has your research thrown up?
Well, the Nifty was trading at all-time highs just on 4th of December when it went to around that 8,626 odd level. But from there, we have seen profit booking, and from those peaks, in fact, the Nifty has lost close to around 560 points. But let's take the data on the base of December 4th close. Now, from there itself, the Nifty has corrected roughly around 5.8%. The Bank Nifty as well has corrected more than 5%, most of that correction coming in today's trading session. The mid-cap as well as the small-cap space, that wasn't spared, so that got hit harder, was down close to around 7 to around 8% odd, while the high beta space got smacked in the face. The Realty Index as well as the Metal Index, both of them lost more than 10%. Let's take you through the metal losers from the Nifty pack itself. Sesa Sterlite, Tata Steel, JSPL, as well as Hindalco, all of them lost more than 10%. Sesa, in fact, was down close to around 18%, while oil and gas stocks as well, they got hit very hard. So GAIL has been struggling. That one was down close to around 12%. BPCL as well as GAIN, all of them saw selling pressure. And the big PSU there, ONGC as well, was down roughly around 9.5%. The story doesn't end with the oil and gas space. Look at the heavyweight stocks. Reliance Industries saw big selling pressure. That one's down close to around 10%. ICICI Bank as well as L&T, big selling been seen on all those stocks, while Infosys, on the back of the big large deal, that stock in fact has lost close to around 8%. The IT stocks had a big rally in today's session, but Wipro, that one ended in the red today, and just in the last few trading sessions, that one has lost close to around 9.5%. TCS, HCL Tech, as well as Tech Mahindra, they pulled back some of those losses, but all of them sitting with cuts in the last 8 trading sessions. The other big losers are up for you on the screen, the likes of DLF, Tata Power, as well as Tata Motors. All of them have seen big cuts, close to around 10% apiece, while on the flip side, we had a few winners. So the Bank Nifty is down roughly around 5%. Kotak Mahindra Bank in that period is up more than 4%. Coal India as well as Ultratech Cement, some of those outperformers, given that the Nifty has cracked more than 500 points. But take a look at the mid-cap space. The likes of Havells have seen big selling pressure. HDI, Unitech, Jain Irrigation, big losses on all those counters.
All right, Nigel, many thanks for that. Now, in the global arena, it's a very critical 48 hours ahead. The Fed will begin its two-day policy meeting today. Expectations are that the Fed will take a less dovish stance on monetary policy at the end of this two-day meeting. Let's hear out Bill Gross of Janus Capital Group on what he expects from the Fed.
As the Fed would admit, it's dependent upon a number of conditions. 1, economic growth. 2, and importantly, inflation. And 3, financial conditions. Why would the Federal Reserve raise interest rates in order to slow economic growth if inflation, in fact, was moving lower? They have a dual mandate from that standpoint, and I think the market basically doesn't respect the second part of that mandate. They speak to it constantly. Janet Yellen speaks to 2% plus type of inflation as an objective. And so to the extent that it's at 1.5 and maybe moving lower now because of a higher dollar and lower oil prices.
Well, so the guess is that the Fed will remain dovish. Take a break on that note. Coming up, Sunil Garg will get us his take on the markets. We also get you some trading ideas.
CNBC TV 18, celebrating 15 years of leadership.